Good afternoon, everybody, and welcome to the latest in this IMAP webinar series. Today we're going to be talking about the state of managed accounts. We're going to use it to talk about the size of the managed account market and more importantly, the underlying dynamics of it. It's my pleasure today to be joined by David Wright of Zenith Investment Partners and Irene Guiamatsia from Investment Trends. So Irene and David, welcome to this session. Before I hand over, I'd like to just take through a couple of things that are coming up for IMAP before we talk about the fund census. Then I'll hand over to Irene. So upcoming events for us. Yesterday we held a very successful inaugural independent thought conference in Sydney with nearly 200 people attending in person. On the 18th of October, we're taking independent thought to Melbourne. It's a chance to showcase the thinking of the portfolio managers, the way in which they're addressing investment issues. In November, Investec, our virtual technology conference. In March, the portfolio management conferences. And then throughout the period, the fortnightly podcasts and periodic roundtables. So of course, all of you are familiar, I'm sure, with how to ask questions through the Q&A function at the bottom of your screens. And we'd encourage you to ask those questions of the way in which our participants today really do think managed accounts are evolving. So let me just start briefly with an introduction to the size of the managed account market. In association with Milliman's, we have every 6 months for the last 5 or 6 years collected the data around managed accounts and the shape of the managed account market. And what I can tell you is that the 6 months to June, characterized by relatively poor market returns, a loss of nearly 10% in the ASX S&P 200, showed a leveling off in the growth of managed accounts from 131 billion to 135 billion. So a growth of only a couple of percent. But let me put that into context, that a growth of 22% in the 12 months to June should be compared with the superannuation market, the $3 trillion superannuation market, which actually over exactly the same period, despite the enormous inflows that superannuation is mandated to receive, actually went backwards by 0.5%. What it shows to me is that managed accounts continue to grow as now a substantial but critical part of the way in which advice is growing in Australia. So 135 billion. Now, how's that made up? It's made up, as you know, into 3 broad parts. The platform SMA market, shown here in red, at about $70 billion, $71 billion, a significant increase of 40% year on year. MDAs, a 5% growth from 48 billion to 51 billion, and a slight shrinking over the 6-month period, probably mostly associated with market returns and a loss of 10%, as I said before, in the managed account market, in the ASX 200 and other listed markets around the world. But the other category is interesting, isn't it? A return to growth for those types of managed accounts that aren't platform-based managed investment schemes or SMAs and aren't the traditional MDAs. So this is superannuation trustee discretion. One platform in particular focuses on that. This is IDPS-like. This is some wholesale MDAs. So a number of structures now emerging and really growing quite strongly over that 6-month period from 11 billion to 15 billion. Still a minor part of the market, but nonetheless one with significant growth. I'm not going to dwell on these factors because we're going to be talking about them in the Q&A session. But to my mind, the factors that have driven growth, the factors that have driven compound growth over the last 6 years of nearly 30% per annum have been these. And as I say, in the discussion session, we're going to be talking about the sorts of themes that emerge from this slide. And I have some strong views on the relationship between the professionalism that organizations such as Zenith, for example, bring to the management of portfolios and managed account structure, and the professionalization of advice and the integration of that. These 5 factors that seem to me to be important aren't separate factors from themselves. Each is interrelated with the others, and we're going to be talking about those later today. So it's now my pleasure to hand over to Irene Guiamatsia from Investment Trends to talk about the research which Investment Trends have undertaken amongst advisors about the use of managed accounts. Irene, over to you.
Thank you, Toby. First of all, can I thank you, Toby and IMAP, for the opportunity to address your membership today and to contribute to such an important discussion on a solution which, as far as we know, has been instrumental in enabling advisors to really navigate a challenging business environment over the past decade, and really to set the industry as a whole in good stead for the future. So I've chosen selected insights to share with your membership today. And this selection comes from our menu of over 40 research reports that we produce on an annual basis, including our latest managed accounts report, which was in field in January 2022. So if I just actually start by borrowing the figures that you've just shared with us, Toby, clearly these results certainly bring in sharp relief the strength of managed account fund growth, which really in the context of this year's subdued equity market, as you've indicated, the equity market performance really underscores the strong inflows that advisors would have continued to direct to managed accounts as a solution of choice. So what our research really allows us to understand is actually sort of dive a bit deeper and really understand at a granular level what advisors are doing specifically to actually deliver those outcomes. So the first thing I'll speak to is the trifecta of factors that have actually brought this to bear. Number one, what we're seeing here is that more advisors are using managed accounts. So you can see over many, many years, we've seen a continued and consistent growth in the proportion of advisors using managed accounts. And in the latest measure, more than half, 53% in fact, of advisors are using managed accounts. So that's reason number one. Reason number two is that if we look at advisors who are using managed accounts, they are actually using it for a larger proportion of their client book. So they're using it for more clients. That's reason number two. And we can see how in the past couple of years, that proportion had actually remained more or less steady, but it's really jumped in 2021. And then the final reason is here, advisors putting more money from clients into these solutions as well, which kind of delivers the outcome that we've shown from the outset. All right, so this is the trifecta. If we kind of then cast our view ahead, the growth certainly looks likely to continue as far as we can tell. So back in January 2022, when we run this research, managed account advisors reported allocating some 39% of new client inflows to managed accounts and intended for this to continue and to be at about 46% in 3 years' time. And certainly those most recent census figures that you've just shown, Toby, actually reflect the fact that advisors are already acting on these intentions. When we look at the green line here, these are potential managed account users. So those who are not using it but intend to start, they're sizing their ambitions in that sort of 3-year time horizon at 17% of new client inflow into managed accounts. So certainly more growth lying ahead. If something else that is of real interest to us and that we continue to observe quite closely is the client type that advisors are seeing the solution being fit for purpose. And so what we've done for many years, and we've shown here just 2 years worth of trend, we've been asking advisors which client type they see as being sort of suitable for these solutions. And in the main, it tends to be affluent clients. There are a number of reasons why advisors are slightly less likely to actually think that the solution as a whole of portfolio solution is suitable for high net worth individuals. And this has to do with, I guess, off-platform assets, such as, venture capital trusts, real assets, and so on. But in the main, it's been this group here of affluent clients. Now, in the past reporting period, as you can see, advisors are increasingly seeing managed accounts as a good solution, a suitable solution for more client types, including millennials, including clients with SMSF, and really right around the spectrum. So as we sort of touch on client type, I think it's kind of important to actually rewind a little bit to contextualize and evaluate some of the challenges past, and maybe sort of infer on those challenges that are lying ahead. So there's a collection of slides here. Apologies, it is a bit of a busy slide, but just really to, I guess, condense and summarize where we see the current state of affairs. So on the left-hand side, here, we can see that the number of advised clients have been reducing. We can see that from the advisor's perspective, there are more clients actually falling into passivity, and I'll come back to that in a second. And then finally, we can see a reorienting of advisor business models to service a bit more the high net worth pool and also the mass affluent pool. So if we kind of cast our views back to, before FOFA was announced, any single kind of advisor practice would have had 70% of their client base made of a mass market focused clients. And now that has changed quite drastically. Now, all of these are issues certainly sort of in a live consideration by the quality of advice review. So without sort of prejudicing any of those ongoing deliberation, what we believe is established and broadly agreed is that the desired future of the industry is one in which regulation can support and enable the majority of clients who need advice to access it at a cost that is commensurate with the scope required. And then which brings in sharp relief the issue of scale and exactly the problem that managed accounts help solve. And so with that, I'll just like to share some quick points. We have, abundant data and evidence that we can kind of use to supplement and substantiate really the impact of managed accounts. But I'll just kind of share a few with you here to really illustrate the benefits of managed accounts for both the clients, the advisors, but also the overall business environment. So first things first here, just back on that issue of scale, when we refer sort of broadly to managed accounts, it is important to recognize that in the main we're referring to managed investment schemes, so SMAs, as it is sort of referred to in industry parlance. So this is what the vast majority of managed account advisors would recommend to their clients, and this is what delivers those kind of efficiency benefits in servicing multiple clients at scale. There is a group, not negligible at all, a substantial group of advisors here, 16% by our latest measure, who use MDAs, managed discretionary accounts, to actually deliver that more bespoke and personalized portfolio construction, and which actually shows of the advisor client value proposition as well. So that's just kind of for perhaps a bit more context. Let's talk about benefits to clients. Now, this is from the viewpoint of advisors. So we've asked advisors what they see as the benefits of managed accounts for their clients. And the results here emphatically suggest that the growing appeal of managed accounts is really consistent with a customer-centric approach and advisors' best interest duty obligation. And here is what we mean. There's a first set of, a first cluster, as you referred to, of reasons that are all related to the advisor having enough time to actually look very closely at their clients' financial and lifestyle goals, and that sort of coaching partnership between the advisor and their client. So that's the first cluster of reasons. The second cluster of reason really speaks very specifically to some of the technical benefits of managed accounts, which really deliver on clients' objectives, such as tax optimization, ESG alignment, and all of this is made possible by the greater transparency and some of the other benefits here in the light blue clusters. So managed accounts really deliver an array of benefits for clients. So that's kind of the number one consideration. But the second consideration, very importantly for this audience today, is also the benefits for advisors. So when we ask advisors what the benefits are for them specifically, really the first thing that comes up, and it has been increasing for the past 3 years and more, is freeing up their time to actually reinvest that time to value creation in areas that would really benefit their clients and solidify that relationship with their clients. So I'm not going to sort of go through all of the detail, but you can see that on average, we just see a growing number of reasons here cited by advisors. And really to put some numbers on what we're talking about when we refer to efficiency gains, we specifically ask managed account advisors to estimate the number of hours that they save on a weekly basis on each of these various jobs that are part of the advice delivery process. And we can see that based on advisor self-assessment, the time saved adds up to a staggering 16 hours. So this is 2 full business days saved per week. And so with that, I'll just leave you with this slide here, which actually speaks to the very market environment where we find ourselves in and that we've experienced in recent months. Being able to directly quantify the positive impact of managed accounts on really a broad range of aspects. So here back in 2021, which was right after COVID, and advisors had the ability to really look back and evaluate the impact of managed accounts on their business amid the disruption and also the huge market movement that so many clients want a lot of execution and really act on their portfolio rebalancing quite often. Advisors here emphatically assessed that managed accounts really help them deliver on a number of fronts. And so that result, which was measured last year, clearly suggests that managed accounts can and perhaps should play a significant role in times of heightened market volatility, where demand for execution quality, but also for the counsel of trusted advisors are both at a premium. And so I hear a sign from Toby. I think we come to time, but I'll just leave you with these 3 key points and look forward to receiving your questions later. Thanks, Toby.
Thanks very much, Irene. No, that was just me clearing my throat, not a sign from Toby. No, look, it's now my pleasure to hand over to David Wright. Let me just share my screen. David and Zenith have been absolutely at the forefront in the development of managed accounts and the provision of professional portfolio management services to advisors, virtually since managed accounts became a thing. So David, over to you.
Thanks very much, Toby and Irene. And yeah, that's right, Toby. I might sort of pick up on Irene's last point, actually, and which is a very good one. And that is if you could flick a couple of slides in, I think, Toby, prior to sort of jumping into some of these key points. The volatility in markets, the one thing, I haven't sort of put here is that we've seen a lot of portfolio activity. And that's in a range of forms, so when you do get volatility like this in markets, you obviously get distortions in the underlying portfolios, you know, whether that be at the very high level, even from, you know, your growth defensive mix, and then, you know, cascading through to the different asset classes within the portfolio. So, you know, that actually can present some potential breaches of constraints that are in PDSs, that are in investment policy statements and so forth. So we've certainly seen and been involved in ourselves, of course, as a model manager, a lot of rebalancing of portfolios. And if you sort of throw in there, obviously we've had the June financial year end, in which you get lumpy income distributions, and that can lead to cash buildup if you have managed accounts where the income is being retained. Now, as many of you would know, you do have that option with customised managed accounts as to whether you retain the income, choose to retain the income within the accounts, or whether that's paid out. And we do find that it's, you know, for those that are or we're managing retirement or drawdown portfolios, the majority of those choose to have income paid out. So that, you know, even in normal times, you will have a period of rebalancing come the end of July, post a June end of financial year, due to the income distributions paid from the underlying investments in portfolios. So there's been that portfolio activity. There's been strategic asset allocation changes, of course, as a result of, well, both upgrades in capital market forecast returns. The market moves have been so significant that, you know, many, ourselves have been included, have updated forecast returns for the different asset classes, even though they are long-term based returns. The market moves have been significant enough to change those. We've seen, you know, the remix of fund selection. A lot of portfolios were, you know, I guess, slightly, if not strongly, skewed to the growth investment style, and with the, you know, emergence and what looks like continuation of strong inflationary pressures, you know, that it usually is an environment in which value and the value style will perform well. So we've seen that, you know, the change in mix of investment styles through, you know, both Australian and international equities, combinations of funds. So a lot of portfolio activity, and of course the managed account structure lends itself really well to that. The ability to do all of those things, change strategic asset allocation, change fund mix, rebalance, allow for rebalancing of the build up in cash as a result of income distributions, can be done on a global basis across all of the clients in that portfolio. And that's, you know, I think a huge benefit, as Irene mentioned, in times of volatile markets for the managed account structure. You know, the other thing that we've seen, and, you know, thankfully, because, you know, we have had and do have alternatives within managed account portfolios for clients, finally, we've seen some strong performance from some of the alternative strategies. You know, I talk of sort of managed futures, global macro in particular, where that really has provided some, you know, one of the few shining lights, I guess, particularly in the June quarter, which was pretty damaging across all investment markets and asset classes. And so the kind of question we're getting from clients, and, you know, we talked last time, Toby, about a lot of advisors kind of capitulating, I guess, on using alternatives in portfolios because they'd lagged for so long, really pretty much since the GFC. Finally coming to the fore now. And so the question is, well, you know, is it too late? Has the horse already bolted? You know, our view on that is that, no, it's not. You know, we are likely to be continuing in a period of higher volatility in markets, central bank monetary policy tightening. We don't know where inflation's going to stop. We do have geopolitical risks. You know, the Russia-Ukraine crisis, of course, is ongoing. And then, of course, you know, China, Taiwan. And so that kind of leads into the next point, you know, a lot of questions around emerging markets and China exposure in portfolios as well. So we don't think it's too late for alternatives. In fact, we think it's an environment in which, you know, alternatives are going to be very important in portfolios, both as a way of generating returns for investors, but also as a way of protecting capital. As I said, emerging markets and China in particular has been kind of front and centre in our recent quarterly investment committee meetings. And it is interesting the reliance of China now on not just their own domestic market, which of course is pretty commonly known is an ageing market. So their reliance on other economies is very important. So, we wouldn't think they'd be wanting to do anything too drastic to risk that in relation to their activity in and around Taiwan. And so, we did actually, interestingly, see emerging markets hold up better than some of the developed markets in that June quarter, where the valuation of emerging markets was a lot more attractive already than developed markets. So the pullback in emerging markets actually did assist from a valuation perspective. Is it now time for value? In a similar sort of question, is it too late? Some of the value managers have, provided really strong returns already. Having said that, the kind of value growth investment style has flip-flopped somewhat. And again, I think we talked about that last time. That's kind of slightly unusual in that you would tend to see the movement from one to the other persist for longer periods of time. But, it does look like a more conducive environment, at least to value. So not necessarily at the expense of growth, but needing to have some value representation in portfolios, I think would be, at this point of the cycle, extremely important. The other one that's we'll probably talk about this ad nauseum in future seminars as well, Toby, of course, is ESG. And, that market does continue to move. I may have mentioned last time in constructing ESG portfolios or managed account portfolios for clients, the responsible entities, the platform governance teams are much more diligent on that. We saw ASIC make a release around greenwashing and basically don't do it. Not a lot of guidance around what not to do, but certainly a shot across the bow in terms of if you're not fair income about your sort of ESG practices, both in terms of individual fund managers, but as in terms of ESG portfolios as well, you really are risking the wrath of the regulator. As I say, it's not as prescriptive as some regulators in the market, most particularly kind of within Europe around greenwashing. So the market continues to move there and evolve to the extent that the requirements around constructing and reporting on ESG portfolios is much more intense than it was. And things like, I guess, again, we mentioned previously, climate change, carbon emissions, and the ability to report on those is, quickly going to be required, I think, within both individual funds and portfolios that claim, some sort of ESG or responsible investment approach. Real asset funds, I know this is kind of a point of tension for a lot of advisors, and Irene's presentation spoke to it as well. It has tended to be the domain of perhaps some of the high net worth or higher net worth advice businesses, private banks and so forth. And part of the reason for that, well, one, historically has been access, but two, we don't so much have problems with access now. We've certainly seen the emergence and launch of global direct property funds, direct infrastructure funds, private equity, private credit's been very popular, commodities, transport assets, water, the whole kind of shebang. So the access is certainly not as much of an issue as it was. Including them in managed accounts is challenging. It can be done, and it can be done on some platforms, and certainly most of the platforms are working on, a mechanism to better facilitate that. But right at the moment, it is a real challenge to mix some of these funds and products that are not daily liquid with daily liquid exposures in a managed account construct, because it's the lowest common denominator really determines how you're able to rebalance and readjust portfolios. So that's, I think maybe a point for discussion, Toby. The other, of course, is RG97. So this is both, comes into effect the end of September, so this month. We're seeing a lot of the individual funds and managers update their PDSs with the new and required, there's been a 2-year transition here, the new way of reporting fees. And I think and of course we need to do that in managed investment scheme based managed accounts. So it's worth highlighting that, because in many cases, the fees are likely to look higher to the end investor, which of course they're not. It's just the way that they, they're now reported, and, I guess a lot more granular and transparency. So, we've moved from, acronyms like MER to ICR. Now we've got, TIC, or total investment cost, is now the real kind of cost that we need to focus on from an overall either fund or, managed account portfolio construct, Toby. So, probably plenty to talk about in discussion, and perhaps some questions from the audience as well. So I'll stop there and provide plenty of time for that discussion.
Yes, great. Look, thank you very much, David. And so now it is an opportunity. We've had a couple of questions come in from the floor. And so to answer the perennial one about the slides, yes, we will be distributing the slides. They'll be available through the IMAP website, and those of you who attend will get a link to that. Just to pick up on David's last point first about RG97, yes, it's tedious. Ironically, this could lead to less transparency of fees because, of course, it affects SMAs as well as MDAs. In fact, I've been working through the implications for MDAs myself in the context of my involvement with Philo. So we could end up, exactly as David said, having to explain more carefully to clients. So look, thank you very much, both David and Irene. You've both given us really interesting perspectives into the advisor views of managed accounts, and David into the challenges that you find in managing them. So Irene, let's start off by talking about advisors and their approach to the issue of high net worth. We had a question in there about high net worth. So thinking not just about the managed account space, but about other research which investment trends undertakes. How do advisors think about the segmentation of their clients and therefore the appropriate services to offer to each of those segments?
Yeah, thanks for the question, Toby. And if I can just pick up on the one that was on the chat specifically, certainly 500K is probably not enough by way of definition of a high net worth client. But the reason why we put the threshold there is that these are assets managed by the advisor, knowing that many of those assets that are off platform are often managed elsewhere and differently. So that gives a sense of why the difference here. When we think quite broadly about the needs or perhaps the support that advisors are providing high net worth, we kind of look at it from both sides, from the perspective of what advisors are telling us about the clients that they're looking to service or that they're servicing, but also from the perspective of high net worth clients. So as you have rightly pointed out, Toby, we also do survey. So what high net worth individuals, and actually what most clients really want from an advisor is an accompaniment support that can actually be dialed up and down depending on their life stage and depending on the specific advice needs that they have at the time. And kind of to use jargon that we refer to internally, we look at validators, we look at delegators, and we look at self-directors. So those are the three personas when it comes to the advice relationship that we tend to put clients into. And so what we tend to see with quite a great deal of emphasis is that those high net worth clients in particular are more validators than delegators. And so what this means is they want to be able to fully sort of participate in that relationship in terms of carving out what the advice is and in that sort of working relationship with the advisor rather than kind of fully delegating their financial affairs, if that makes sense. And so what that then brings to the fore is that for that to be enabled, it is important, number one, for advisors to have time to have those discussions. And also, so yeah, that's a very important consideration. And so also from the perspective of the client itself, to be able to really rely on advisor as a trusted partner. And so that issue of trust as well is particularly important. So a few things there, I think, just kind of to circle back to your question, Toby. So it's about being able to rely on the advisor as that counsel, and to really be able to trust the advisor and to have perhaps assurance that the advisor is looking after the client's best interest and actually has the time to do so. So I hope that kind of gives a bit more context.
David, I mean, I think we saw in Irene's slides that managed accounts are now becoming a more significant part of that high net worth client relationship. I mean, from your experience in dealing with the wide variety of advice practices and licenses that Zenith does support, thinking about those who do have a genuinely higher net wealth client base as opposed to those who are more mainstream. I mean, do you see differences in the requirement for managed accounts? I mean, the ways in which they think about them, the types of investments that they want to have included in those, or perhaps even the engagement that they want themselves in the portfolio management process?
Yeah, we do. And it is related, as you say, probably more so to the type of product, I think Ian's asked a really good question about, direct.
I have an answer for that question. So.
Yeah, I was going to say, like, you'll be able to answer the percentage breakdown better, but I do think, the differences usually, and this is a bit of a generalisation, but in that high net worth space, probably greater use of direct equities as part of, a managed account solution. And, some of those kind of less liquid or bespoke type investments or sub-asset class exposures within the kind of portfolio construct, I would say is probably the kind of two key differences we see. In terms of, it's a good question you mentioned about, more or less involvement. I wouldn't necessarily say that. I mean, there are, of course, people that want to be quite involved and at investment committee level in both camps, if that makes sense. So you're kind of mainstream, for want of a better term, advice businesses and your high net worth, and there's others that sort of really kind of saying, look, and I think that was one of the things out of Irene's presentation, like we're outsourcing this to, the portfolio specialists. And yes, we'd like obviously to be, the investment committee reporting and so forth, and performance attribution and showing that the model manager is actually doing their job. But, kind of outsourcing that, that's been, one of the reasons or rationale for them bringing managed accounts into their business in the first place.
Yeah, to my mind, as I said in my sort of first introduction slides, one of the key drivers, it seems to me, is professionalism in a sense of engaging with professionals like Zenith and the other consultants. Also, the obligation to run more professional businesses. I mean, there's actually a requirement in the Corps Act to deliver services efficiently, honestly, fairly. People tend to miss they tend to focus on the honestly. They tend to miss the sort of implications of of a legal obligation to be efficient as well as fair. Managed accounts actually play an ideal role in delivering, in an efficient business delivering services efficiently. So I think that's misunderstood.
I think, hey, Toby, just if I could add to that, I mean, I think the other big one there is the quality and depth of engagement via reporting. So, if there's criticism of managed accounts, sometimes it is, well, like I want to have a bespoke solution for each and every one of my clients. And, the big drawback, well, there's, in my view, plenty of drawbacks to that, but one of them is the inability to realistically provide in-depth look-through reporting to your clients, whereas in a managed account, and most practices will have a range of different managed accounts, just puts you in a much better position to be able to engage with clients in a more detailed way from a portfolio reporting perspective. And I do actually think that's been one of the big advantages the managed accounts has demonstrated, above obviously, I guess, single multi-manager funds.
Yes. And look, it was interesting to me that when the winner of our multi-asset class award this year was MLC Asset Management. I mean, they brought, who've brought kind of 30 years of experience in running multi-manager funds to the delivery of that sort of expertise delivered with the constraints of managed accounts on platform in their case. With the to a managed account world and focused on some of the reporting and transparency issues that you mentioned, David.
If I can perhaps follow up quickly on that point, Toby, and linking to one of the questions in the chat as well, which was around the reasons for choosing a platform. So one would be sort of tempted to think that the range of SMAs is like right up at top of the list. It is a very important sort of factor, but actually even higher than that is reporting, which we're talking about just now. So it is a really important consideration from the perspective of advisors when they're actually picking a platform to implement the sort of managed account solution.
I mean, reporting is one of those things. I mean, if you think about sort of the management of services, not just in our own area, but just the management of services generally. When I was at university studying marketing, it was how do you make tangible the intangible? And our services are intangible. David made the point about building trust, and obviously that's making it tangible at a personal level. But you're right, Irene. It's always seemed to me that the reporting is one of the few things that you can articulate. What is this all about? What are we doing for you? On your behalf as an advisor, with that whole sort of infrastructure behind him or her.
Yeah.
We're going to see a lot more of these ways of making tangible the service that we deliver. So that's interesting. I think so. Let's. I don't want to let the ESG issue go by, because again, it seems to me that it's got implications. I've got sort of quite a bit of thinking about this, and this year for the first time we did have an ESG award in the IMAP awards category. So I want to talk about ESG again, Irene, in a general sense of how advisors are facing into the ESG requirements, and then David, the implications of ESG for managed account portfolio construction.
Yeah. So just some perhaps some quick high-level comments to start. Advisors and ESG. What we found in our research, and we've done this from two perspectives, David and Toby, from the perspective again of the advisor and the investor, and we found that it's actually investor-led. So this conversation around ESG is one that has actually been driven by investors coming to, ask the advisors, okay, how do I align my portfolio? And advisors are like, oh, I need to actually figure this out and be able to have that conversation from a position of knowledge. So that's number one. Number two, advisors are really sort of enthusiastic about ESG, not just because, they kind of see that it's an all-important consideration, but because also it suddenly creates a reason, or perhaps, substance to actually deepen and strengthen that engagement with their clients. We find that advisors who are having ESG conversations with their clients are actually really have that client retention strategy really bolster. So that's kind of what's in it for the advisor, if you will.
I live in Warringah, the original teal electorate. So yeah, I can tell you, these are values-based conversations.
And so if I then go specifically, Toby, into how managed accounts advisors are thinking about ESG, it's still quite open from what we can tell. So we've asked specifically questions to advisors around managed accounts, and we've said, would you prefer to have managed accounts, in the sort of same structure that you are accustomed to, with just, a few tweaks that you can make to make them ESG, whatever that is, and we can talk about greenwashing later. Or would you prefer sort of bespoke ESG portfolio, or would you actually prefer for the investment managers to have like an ESG sort of overlay across everything that they do? So all you need to do is actually to go to the investment manager and not kind of worry about which specific product you are choosing. In the main, we actually find that advisors are saying, oh, just give me an ESG tilt. So that's 44% though. It's not the majority, but that's the biggest group. And then the rest is distributed across those two other options. So I think it's kind of an open field. And I think advisors perhaps needs or demands are going to evolve with where they see the market also move towards.
Yeah. Because David, I mean, there must be one of the challenges in ESG is that, at the client level, as Irene said, there's about clients' perceptions. I mean, one client says climate change is the big issue for me. Another says, well, yeah, but gambling, that's personally, I abhor gambling. And others have different views. So as a portfolio manager, working with advisors and licensees, on portfolios that are held uniquely by clients. I mean, how do you deal with that as an issue in portfolio construction?
It's a great question, and it's a real issue, Toby, as you say, because it's in a pooled structure like a managed fund. It's going to be impossible, even with a kind of ESG dedicated manager or product, to satisfy every investor's kind of ESG thoughts and criteria. I mean, I think the first step, which was, and to be honest now, is reasonably easy, is the kind of negative exclusions. So we as an industry now, we do have data on what managers exclude and don't exclude. So, with our own kind of mosaic website, have built a tool that people can select tobacco and gambling and armaments and so on and so forth, and see what list that produces, both kind of mainstream and dedicated ESG managers. So there's that aspect. I think the other, and we may have talked about this as well previously, is that as Irene said, we've got at the moment just kind of, one client actually that said, look, I want all my portfolios to be ESG RI, driven. Whereas the kind of those, and again, it's not across the board, as Irene said, but those other groups that have said, look, we need an ESG solution for clients. We've built one or two, or in one case, 3 dedicated ESG portfolios for. So there's that aspect. And interesting, I said to one client, okay, with that approach, what do you want to call them? The ABC ESG or the ABC RI portfolios? And he kind of thought about it and said, look, well, to be honest, neither. Because I don't want to give the impression, that what we're doing and what we've been doing over here is black, and now we've got this nice white. So I actually think that's something the whole industry faces, from a kind of, in some ways, transitionary position.
That's a have you stopped beating your wife question.
Well, yeah, I mean, yeah, so it's, and I think, again, as I mentioned, and it is interesting, we're just doing the kind of international equities sector reviews at the moment, Toby and Irene, and the growth you know, over the last few years in new product issuance has certainly been in the ESG space. And this year is very much in, you know, the climate focused space. So, and that'd kind of echo, you know, to be honest, what, yeah, of all the ESG kind of criteria, for want of a better term, that's probably the strongest right at the moment.
Yeah.
The only other thing I'd say,
it's sort of it's a reflection of what's going on in the broader world. I mean, ESG really kicked off, and sort of my perception is when we had the bushfires 2 summers ago. Suddenly, you know, when you can look outside and the sky's bright red, and you go, this is not how it's supposed to be. And now with the issues around, you know, Europe and gas and you know, like it's clients reflecting their view of the external world in their portfolios, and the advisor has to intermediate that. It creates unique opportunities for advisors.
It does, although the other thing I'd say with that, and you again, you kind of knocked the nail on the head, Toby, in that, again, there's been major dispersion, right, in the returns of ESG product and portfolios. And again, for want of a better term, let's call them traditional, because you had that period where, you know, energy prices went through the roof, energy stocks went through the roof. Energy stocks are not, you know, commonly held in kind of ESG. And as I said before, you've also had alternatives perform well, and alternatives at the moment, yeah, well, not across the board, but many alternatives don't rate well on an ESG criteria. So you sort of had 2 cannons firing in kind of traditional, which you never had in ESG. So you had this big dispersion. So that, in some ways, that's good, because it kind of tests people's, you know, commitment. That of course has corrected itself to some degree, not on the alt space, but certainly energy wise. So there will be swings and roundabouts. I'm not by any stretch saying ESG will always underperform. In fact, prior to that, quite the opposite. You know, a lot of the best practice ESG stocks were being bid up for that reason. So, but there will be meaningful differences between the performance of, you know, traditional and ESG portfolios.
We had at yesterday's Independent Thought Conference, we had John Julian from AMP Capital talking about infrastructure. One of the points he made is that in thinking about infrastructure as an investment option for including, you know, in managed funds, one of his observations was, yes, there's sort of some of the renewable and green and solar power and wind power investments that have, you know, that they consider don't make the cut precisely because they've been bid up. You know, they have a sort of scarcity value, particularly for European investors or for deep green investors, that make them then, you know, you just can't get them across the line in a more conventional investment management perspective. And
if I can perhaps jump in here and add, you know, a few points to the discussion around returns specifically. So that's one area that, of course, we've examined in quite a great deal of detail, because there's that, I want to call it myth, but you let me know if it's been debunked or not. But there's certainly a view that to align your portfolio with ESG, you need to trade off something, and that something tends to be performance, just back to your point, Dave. But what we have seen, you know, perception being reality in this guy, when we speak to retail consumers, what we have seen is that increasingly consumers are evaluating ESG performance from a long-term perspective, and more they are saying that they're seeing, you know, green when it comes to what ESG can return versus, I guess, traditional investments. So I think it's kind of just an important thing to keep in mind. Of course, in the short term, you know, you kind of just look back and see the year that was. But when investors reflect on the longer term, they are tending to have a bit of a different view now.
The sort of mention of infrastructure, and I'm conscious of time, and there's a couple of questions which I want to come back to that from the audience, but I do want to touch on the sort of infrastructure and the less liquid investments. You touched on it, David, and I'd like to come back to it as being one of the issues in managed accounts and the way in which it's going to be addressed, because I see it being, sort of progressively we're getting there. But from your point of view, how do you think about those less liquid investments and both the investment opportunities they provide, but the challenges of accommodating them?
Well, it's really front and center at the moment, given that, some of the direct assets, historically perform well in a rising inflation and interest rate environment.
Yes.
So, of course, there's interest, there's demand, and, we've spoken before about, the Future Fund and others now, some of the industry funds being quite kind of, in the media talking about their portfolio positions. So, of course, clients are asking advisors, can I get access to that? And in theory, yes, you can. In a lot of cases, even private equity and private debt is available to retail investors through, not a lot of funds, but there are some. But to answer your question, Toby, like right at the moment, in the vast majority of managed accounts that we manage, it is too problematic to have, less liquid exposures from a portfolio management, trading, execution, and rebalancing perspective. So, I think, as you know, we had you had Matt Heiner on here last time, talking about, well, we're working on this, and a number of platforms are.
Yep.
So, I think, having said that, the problem, as I said before, I think with most platforms, you probably can already, in terms of have a managed account that is dedicated, if you like, to liquid investments and kind of allocate to that separately. But of course, that dilutes some of the efficiencies.
Yeah, and in fact, there's a question here from Anonymous. Gosh, I ask a lot of questions, that Anonymous. What are the benefits, cons of MDA versus SMA structure? Can these be easily interchanged? And in fact, this is actually one of them. That as you increasingly MDA services, and I've got a bias, but the sort of technology is enabling, this type of investment to be incorporated into a sort of a systematic structure. In a way that some of the platforms find more challenging, although I know that they're all focused on it. Look, I'm conscious of time. Ian Matheson, we haven't got to your question about the share of direct equities. What I can say is we do actually, as part of our fund census, we do ask for asset type. We don't look at asset allocation. It's sort of beyond our scope, but we do look at asset type. And in fact, what's happened is that managed funds have been a pretty consistent sort of 40 to 42% of managed accounts over the last 3-4 years or so. Direct equities have in fact, though, directly held stocks have plummeted from nearly 40% to about 25% now, but that's been almost completely offset by the growth of ETFs. So you can say that listed investments collectively is sort of now 47% or so, whatever it is, that there or thereabouts of managed accounts. But in fact, what we've seen as more and more ETFs, more nuanced exchange traded product comes to market, that's substituting for direct stocks. So we're seeing, managed investments a significant part of portfolio. So if you combine managed funds and the sort of ETF market, you end up at a probably 57%, nearly 60% of managed accounts. Cash is pretty steady, 6%. International equities grew this period for the first time ever, really. It had a significant increase, but it's still under around about 5%, and every other asset class nowhere. So yes, what we're seeing is a substitution of directly held stocks, portfolio of stocks for ETFs. So, David, I don't know whether, in your view, because I know you focus much more on managed investments rather than direct stock picking, whether those sort of ETFs and listed products are now sort of much more in your sort of universe?
Oh, certainly in the universe, yeah, and being used, Toby. I think part of the answer to, as you said, ETFs becoming a greater proportion is that, you know, with respect, if you're a dealer group or even broker with model portfolios of direct equities, that often that's not going to get past the RE and the platform governance. You know, what we do find is that you know, separately managed accounts that are managed by a professional manager are required for that direct equities exposure to certainly in a managed investment scheme, managed account on platform. And so, as you said, like the kind of substitute to that is ETFs, which, you know, passes through that sort of criteria more easily.
All right. Look, our time is at an end. Irene, Guiamatsia, David Wright, thank you very much, both of you, for a very interesting discussion about managed accounts, the state of them in 2022 and the opportunities for growth. So thank you very much. Thank you all for joining us today, and we look forward to you participating in future IMAP webinars. Thanks very much.
Thank you, Toby.
Thanks, Toby.